morning. This is the conference call for TGI's results for the first half of 2013. We're going to start with a bit of a recap and overview of TGI, then move on to our financial and operating highlights for the past quarter, and then talk a little bit about the expansion projects we are working on. As you all probably know well, TGI, we're the largest natural gas pipeline company in Colombia. We have a strategically located pipeline network and are a regulated monopoly in the areas where we operate in. We have, as a regulated company, we have a very constructive and stable regulatory framework, which enables us to produce stable and predictable cash flow generation. And that produces itself into a strong and consistent financial performance, obviously, which comes hand in hand from the experienced management team and support from our shareholders. We're a relatively young company. We were created in 2007 when the government sold off the assets of Ecogas to EEB. And we've been on a pretty consistent growth path since then, and we now own approximately 57% of the national pipeline system in Colombia, and serve about 70% of the area where about 70% of Colombia's population lives, and which generates approximately 80% of the GDP of the country. Moving on to our highlights for this first half of 2013. In terms of our operational highlights, our network length has not been modified this semester or this quarter because we finished our latest expansion project in August 2007, so our network length remains stable at 3,957 kilometers, as well as our transportation capacity at 730 million cubic feet a day. However, and this is something that has been consistent and will continue in the following months and quarters, our contracted capacity continues to grow as we renew contracts with existing clients, some of which require more capacity, or we sign up new clients. And so now we're now at a contracted capacity of approximately 628 million cubic feet a day. In terms of transported volume, in the first half of 2013, we transported an average of 436 million cubic feet a day, and that is an increase from 2012 when we had 422, and 2011 when we had 420. This is the result of, on one hand, growing demand in the residential, industrial, and commercial sectors, as well as slightly higher dispatch in some of the power plants that use natural gas as fuel. In terms of gas losses, we are at 0.4% gas losses, which is well within the gas losses we're allowed to have, which are 1%. So we're comfortable with this number, and actually it might continue to trend down slightly. In the first half of 2013, we had an incident in the pipeline in January, as you might remember, and that increased our gas loss numbers for this first half. And the gas losses for the years 10, 11, and 12 are abnormally higher because we were finishing expansion projects at that time, and when the expansion projects are put into operation, there's need to vent gas when you do the interconnections. And in terms of load factor, we're at approximately 60%, which is a number, as we've said before, which we're fairly comfortable with. We need to have spare capacity to be able to keep up with the demand of the thermal power plants when they are all dispatched. And we also need some spare capacity so that we can allow our customers to grow into their demand, because we can't be adding on new capacity every year. So we need to have some excess capacity, and we're fairly comfortable with the number we have. In terms of our market position, although we're fairly separate systems, we transported approximately 47% of the gas that was consumed in Colombia in the first half of the year. Promigas, which is the other large pipeline company in the country, transported approximately 38%. And other smaller companies transported the other 15%. It's worth noting that most of the gas that the others transport is gas that has been in some way, shape, or form transported through our system. In terms of our revenue generation, as we continue the trend of having our main customers and our main revenue generators be customers with very stable consumption patterns. As you can see, approximately 60% or 59% actually in the first half of our revenues came from the distribution sector, which is what goes to mostly regulated customers, basically residential, commercial, and some small industrials. That is a very stable pattern, and it's been growing over the past few quarters. If you kept up with the presentations, this number was around 50% a few quarters ago. The refining sector, Ecopetrol's refinery in Barranca Bermeja, which is also very stable, consumed about 11% of, or produced about 11% of our revenues. The gas, natural gas that goes to vehicles, approximately 7%, and other industrials, approximately 3%. So with that, you have a pretty stable base of approximately 80%, 77 to 80% of customers with very stable consumption patterns. Around 15 to 20% of our consumption, 15% is power producers, which have more seasonal and less predictable consumption patterns. We have, as you all know, excellent contract quality. 100% of our contracts are firm contracts. The average life of those contracts is 8.5 years, and more than 80% of the revenues from those contracts are regulated, are fixed tariffs. Approximately 76% of our EBITDA is denominated in US dollars, because the majority of the tariffs that are paid by customers are denominated in US dollars, although they are paid in pesos. In terms of our customers, our largest customer is Gas Natural, the distribution company in Bogota and the surrounding area. Second largest customer is Gases de Occidente, the distribution company in the Cali and coffee growing region in the west of the country. Ecopetrol that's with 17%. Ecopetrol has 16% of our had 16% of our revenues in the first half. EPM, Empresas Públicas de Medellín, 12%, and Isagen, the third largest power producer, 7%. Other customers represent about 24%, and those are approximately, I would say, 40 customers represent approximately 24% of our revenues. So we have a concentration in 5 customers, but it's a healthy concentration because of the credit quality of these customers. Next slide shows the profile of our contracts when they are coming due. As you can see, we have rollovers coming in, or maturities coming in December 2020. We are not very concerned about our ability to roll those over because as the date comes, our customers will need to basically renew their contracts and extend them in time if they want to keep the capacity in the pipeline. Demand continues to grow, and so customers will have all the incentives to basically renew their contracts as early as possible so they can maintain and potentially increase their capacity in the pipe. Coming on to our financials, in terms of we've had a good couple first quarters of the year. In terms of revenues, we had last 12 months as of June, $435 million of revenues. That compares with $390 million of revenues in 2012 and $339 in 2011. Big reason for that is the fact that on the one hand, we've had larger contracted volume because our latest expansion program, the Cusiana Phase 2 project, came on stream in August 2012, and that has generated additional revenues because of that. Second, as you know, and we mentioned in our last conference call, our new tariffs were approved by Craig in December, and since the first quarter, throughout the first quarter, we started basically charging these tariffs to our customers, and that has basically resulted in higher revenues than we had obviously in the past few years. In terms of the other thing is, as we saw in one of the previous slides, we have slightly higher volume transported, and although most of our revenues are fixed, we do have some variable revenues that depend on transported volume, and the higher transported volumes obviously result in larger revenues. So if we look at it on a comparable basis, like last 12 months of June 13 versus last 12 months June 12, the growth is somewhere in the 25 to 30% range, which is pretty healthy. Obviously, in terms of EBITDA, that has also resulted in very healthy growth in EBITDA. We ended 2012 with $289 million in EBITDA, and as of June, the last 12 months, we're at 330, which is a growth rate of approximately 14% just comparing to December 2012. And obviously, funds from operation has grown even at an even larger clip, because in here we also have the effect of the reduction in the interest rates in our debt, which increase our funds from operation. So funds from operation increased in the last 12 months as of June, increased to $239 million versus revenues or FFO of $132 million. That's an increase of almost 81%. In terms of CapEx, we have CapEx of during 2012 of $185 million. First half of 2013 is $19 million. We expect an increase in CapEx during the second half, and we expect to finish the year. Our official number right now is about $90 million. There is a little bit of potential to have CapEx be a little bit lower than that, than the 90 million number. So overall, we're going to be fairly or significantly cash flow positive during the year 2013. In terms of our metrics, this obviously has had a very positive impact. Our total debt to EBITDA is at 3.9 times. If we take the last 12 months as of June, total senior debt to EBITDA is at 2.7 times, and interest coverage is at 5.5 times. and will continue to grow during the rest of the year. Our debt has not had any changes. We basically have our senior debt, the bonds of $750 million, sub-debt with our parent EIB, and the mark-to-market of some hedging operations, which is approximately $109 million against us as of June. Moving on to another, so that is it for the financial side. We're very comfortable where we are, and we expect to have the second half of the year continue to be strong, and we'll be able to, I think, post pretty decent numbers by the end of the year. In terms of our organizational structure, what I wanted to communicate to you guys today is that in May, our board basically approved a new organizational structure of TGI. Basically, the main objective being aligning the organizational structure more with the long-term strategic vision that the board has, which is to have a company that is growing strongly and very dynamic. The new structure was in part based on the recommendations of CT Partners, which is an international recognized HR consulting firm. And as part of this process, the board also decided to relocate the company's headquarters from Bucaramanga to Bogota. This is a process that will take us the rest of the year, and hopefully by the end of the year we'll have, if not everybody, most of the people who are now in Bucaramanga, and more than 90% of the people who are now in Bucaramanga in Bogota. In terms of the org structure, the main changes I think are, on the financial side, there are no changes. We created a new vice presidency for development and growth, under which the new business development area will be, and additionally the area that is in charge of constructing new projects, or the actual managing the construction of new projects, that's called Gerencia de Proyectos, is going to be under that in that box, as well as our commercial side, who are the people who basically have the relationship with our existing customers. And the reason for this is that many of the growth opportunities we see are in transactions with our existing customers. So, and those two divisions, the projects division and the commercial division, were previously under the COO, on the Vice Presidency of Operations, and so we that Vice Presidency of Operations will now basically strictly focus on the operations and maintenance of our existing infrastructure, and we think that'll be a very positive thing for the company. And we also created another Vice Presidency, which is for legal and regulatory affairs. You know the importance of regulation and of for a company like us. So we're going to have a new VP that's in charge of not only legal aspects but regulatory aspects, as well as also the purchasing function, which moves from the administrative VP to the legal and regulatory VP. So that is the new org structure. We're still in the process of filling in some of these positions. And I also wanted to mention that at the beginning of June of this year, our long-standing COO, Mr. Jorge Pineda, resigned. And so we had a process to look for a new COO, and have finally found somebody to replace Mr. Pineda as of the end of August. Mr. Mario Garay will be joining TGI. Mr. Mario Garay is Chilean, and he has a very significant and long career in INAP, the National Oil Company of Chile, in their gas and pipelines division. So we're very excited, we're happy, and we look forward to continue to work and grow the company with this new structure. Finally, and last but not least, just an update on our expansion projects. In terms of the Sabana compression plant, which is the project to construct a new compression station near Bogota to increase transportation capacity in this area. The EPC contract was awarded at the end of May of 2013. So with that EPC contractor already selected, which is SNC-Lavalin, or SNC-Lavalin's subsidiary here in Colombia, we expect to be able to give notice to proceed and sign and begin actual site work during the second half of 2014. Sometime in the month of August, probably we'll be giving notice to proceed. So that is going according to plan. Cusiana, Pia, y San Fernando, which is the project we're negotiating with Ecopetrol to construct a new pipeline to bring gas to their power producing or to bring gas to power plants that they have in the Meta area region of Colombia. This project is approximately 247 million project, and we have already signed an MOU with Ecopetrol. We are already in the process of doing the engineering and design work for the project, and once we have basic engineering completed and a budget, a better budget for the project, we'll start the process of signing documentation with Ecopetrol that will allow us to basically proceed with construction. And finally, we are starting work also on engineering for a couple of branches to our network in the coffee growing region, one in Armenia and one in Chinchina, and this will basically increase capacity, delivery capacity to these cities, and we expect to begin commercial operations in 2016, and the estimated cost for this project is approximately $28 million US. So we have a good pipeline of projects which are basically fully financed. We don't need any additional funds or debt to be able to construct this. So we're happy in the position we are, and we expect to continue to find new growth opportunities in the future. That is it for me for now. I'll turn it over to questions and answers, and I thank you all in advance for your time.